Warning: why Wall Street just bought your life insurance. Her mother's annuity check didn't arrive. The hotline blamed temporary adjustments during a reinsurance transfer. Meanwhile, the insurer's reserves had been shifted into private loans no one could see, and a surrender would cost thousands. Across town, the asset manager booking fees on those loans reported a record quarter. Problem: Wall Street just bought your life insurance. Urgency: premiums that once sat in plain vanilla bonds now feed a shadow banking engine run by Apollo, Blackstone, and their peers, today not someday. Promise: you can still protect your income if you know how this works. Solution: we'll map the engine and give you a checklist. First, how safe yield disappeared. When safe yield vanished. After the 2008 crisis, central banks crushed interest rates to the floor and kept them there. For life insurers, that wasn't a policy debate, it was a math problem. Their promises to policyholders, especially on fixed annuities and old guaranteed contracts, were priced for a world where high-grade bonds paid reliable income. Suddenly, Treasuries yielded close to nothing. Mortgage bonds shrank. The spread that funded decades of guarantees evaporated. Urgency spiked as legacy guarantees met near-zero yield, forcing a redesign of the entire engine behind your check. The numbers bite hard when you live off spread. Insurers collect premiums today, invest them, and credit policyholders a rate while holding capital against future claims. In a near-zero world, that spread thins. If you keep buying the safest assets, you risk negative economics after expenses and capital charges. If you reach for yield, you risk the promises themselves. Asset liability management, matching the timing and cash flows of investments to obligations, turns into a tightrope. Regulation nudged behavior too. Under the NAIC's risk-based capital framework, different assets carry different charges. A plain corporate bond has one weight. Slices of structured credit, private placements, or certain asset-backed securities can, in some cases, carry treatment that looks efficient on paper relative to their headline yield. Offshore regimes added another layer. Bermuda's solvency system, recognized as equivalent by global standards, often allows capital relief compared with US RBC for specific assets and reinsurance structures. If you reinsure liabilities to a Bermuda affiliate and take reserve credit back home, you may free capital here while running a risk model there. That's the Bermuda Triangle critics talk about. Risk moves, capital falls, promises look safer on paper. While most of the public argued about low rates forever, a handful of investors saw a structural opening. Private equity firms weren't chasing the next take private. They were chasing permanent capital, the steady inflow of premiums that doesn't need to be re-raised every few years like a fund. An insurance balance sheet is a funding machine if you can manage both sides. The liabilities people buy, and the assets those premiums feed. The pitch sounded tidy. If banks pull back after the crisis and capital rules tighten, someone has to lend. Private credit grows. Who better to fund it than insurers with long-dated liabilities, steady cash, and a mandate to earn more than near zero? If you can originate loans yourself, direct lending to companies, financing aircraft, building infrastructure, bundling consumer receivables, you can capture more spread. If you own the insurer and the asset manager, you can capture fees and spread. Heads, I win on the fee line. Tails, I still earn the insurer's net interest margin. But here's the rub for families. Those guarantees you bought assumed conservative reserves and liquid, observable assets. As yields fell, the temptation rose to reclassify risk, to move liabilities where capital was lighter, to replace public markets with private ones that don't mark to market each day. Complexity did what complexity does. It made strong returns look smooth and hid the rough edges. Best execution for policyholders had to compete with best economics for affiliated managers. Meanwhile, at the kitchen table, the stakes remained simple. That fixed annuity check is grocery money. The life insurance payout covers a mortgage and tuition. If the spread game falters, insurers can lower crediting rates on new money, tighten terms, and lengthen surrender penalties. If stress hits, policyholders discover how hard it is to exit without paying up. The promise feels the same, but the engine under the hood has changed. What nobody highlighted at first was concentration. If several large insurers follow the same path, reinsurance to similar offshore affiliates, heavy allocations to sponsor-originated private credit, reliance on the same funding backstops, risk clusters. A rate shock or a credit downturn doesn't hit a diversified bond book the same way it hits bespoke loans with looser documentation, mezzanine slices of CLOs, or private commercial real estate debt. Valuations in private markets lean on models. Liquidity relies on lines and facilities. In good times, that's fine. In bad times, it's a line item called basis risk. The regulatory backdrop tried to catch up. State commissioners began probing captives and reinsurance structures. The NAIC revisited capital charges on structured and private assets. The Federal Insurance Office raised flags on offshore reinsurance. But the perimeter had gaps: state-by-state oversight, limited look-through to affiliated investments, and disclosures that often arrived after the fact. Bermuda's regime is robust in its own right, but the cross-border dance made simple questions hard to answer. What assets truly back these promises? Who holds the risk if things sour? For private equity, the answer was already in motion. Apollo built Athene from the ground up as a retirement platform, then integrated it so deeply that Athene became a massive share of Apollo's total assets under management, explicit permanent capital, that stabilized fees through cycles and reshaped Apollo's earnings mix. Blackstone followed with stakes, mandates, and reinsurance partners that funneled premiums into its private credit and real assets machine. KKR and others joined in. The model worked. Wall Street rewarded the flywheel. For policyholders, the map of their money changed. Premiums no longer flowed mainly into Treasuries and agency MBS. They funded a broader, murkier credit universe where the same sponsor might originate, tranche, warehouse, securitize, and then sell into an insurer they influence. It's efficient, it's profitable, and it means your family's safety net is now woven with threads you can't easily see. While that was happening in boardrooms, the family at the start of our story kept waiting for a check that used to arrive like clockwork. The system hadn't failed. It had shifted, and that shift began the moment safe yield vanished. The PE-Insurance Playbook. While yields were vanishing on Main Street, a different kind of blueprint took shape in Midtown conference rooms. It started with a simple move. Don't just manage money for insurers, own the insurer, or at least own the asset decisions. If you control the right to invest the premiums, you control the engine. Promise: more yield without more risk on paper. Reality: a vertically integrated spread machine that only works if liquidity, governance, and capital truly keep pace. Step 1 was acquisition or partnership. Private equity sponsors bought annuity issuers outright or took strategic stakes and long-term mandates. Sometimes they built from scratch to buy closed blocks of policies. Sometimes they inked deals with existing carriers that needed asset expertise and capital relief. Either way, the result was the same: new hands on the asset mix. Step 2 was the portfolio shift. Legacy insurers leaned on investment-grade corporates, agency MBS, and liquid public markets. The new model tilted toward private markets that promised more spread. Direct lending to mid-size companies. Asset-backed securities tied to autos, equipment, or consumer receivables. Mezzanine slices in CLOs. Infrastructure and real asset credit. Mortgage servicing rights. All of this could be originated or sourced in-house, then allocated to the captive insurer. When you're both the factory and the customer, your pipeline never runs dry. Meanwhile, something else was happening off the balance sheet. Liabilities were moving. Sponsors used reinsurance, often to Bermuda affiliates, to transfer blocks of annuities out of U.S. entities. That unlocked reserve credit back home, lowered required capital under a different solvency model, and made room to buy more yield. Regulators recognized Bermuda as robust, but the cross-border setup created opacity. On paper, risk was diversified and capital ratios improved. In practice, leverage crept higher via capital arbitrage. Here's where the spread machine really started humming. If the sponsor originates a loan, underwrites it, tranches it, and warehouses it, there are fees at every turn. Sell senior or mezz pieces into the insurer with a long-term mandate, collect management fees on the assets, and still harvest the insurer's net interest margin. Heads, I win on AUM fees, and therefore I also win on insurance spread. And if the paper is private and marked to model, earnings look smooth until they don't. The incentives lined up around growth. Asset managers report quarterly. Insurance liabilities stretch for decades. That mismatch matters. The asset manager wants AUM, mandates, and origination velocity. The insurer should want resilience, liquidity under stress, and alignment with surrender behavior. When both live under the same corporate umbrella, governance has to carry the weight. Best execution for policyholders versus best economics for affiliates. It's a tightrope even for good actors, and a slippery slope for everyone else. Distribution. Supercharged the loop. Fixed annuities, pitched as safety with yield, surged through banks and independent agents. In an era of market volatility, guaranteed income sells. Commissions are real. Inflows ramp. With bigger inflows, the sponsor can scale origination, step into deals banks won't, and securitize more collateral. The insurer becomes a cornerstone buyer of the sponsor's own product. The flywheel turns faster. But there was one problem hiding in plain sight: liquidity. Private credit doesn't trade like a treasury. If policyholders start taking loans against their policies or surrendering contracts during stress, selling bespoke loans quickly is tough. So insurers rely on funding lines, Federal Home Loan Bank advances, or repo against eligible collateral. Those are useful tools. They're also finite. If several PE-linked insurers need those lines at once, availability and pricing change fast. Urgency. One busy week can turn model liquidity into a real-world bottleneck. What nobody knew at the time was how correlated the ecosystem would become. Different brands, similar assets, overlapping warehouse lenders, common reinsurance domiciles. A credit hiccup in one corner could ricochet through marks and funding in another. Ratings agencies flagged it gently by focusing on asset liability management, liquidity, and sponsor support as key pillars. State regulators began asking for more look-through on affiliated investments. The Federal Insurance Office warned about offshore reinsurance concentration. The model still worked, but the questions got louder. Inside the firms, the narrative stayed disciplined. They argued they were matching long-term liabilities to long-term assets and filling financing gaps banks abandoned. They highlighted investment-grade private credit, stricter covenants, and diversification across sectors. They pointed to robust hedging on interest rate exposure. And in fairness, during calm markets, the numbers looked good. Spreads were higher, crediting rates were competitive, and earnings marched upward on smooth lines. From a policyholder's perspective, none of that nuance showed up on a monthly statement. What did show up were contract terms, surrender periods that stretched years, market value adjustments that penalized exits in certain conditions, and crediting rates that drifted lower when the math tightened. During mergers or reinsurance transfers, service could lag. When families called for clarity on where their money sat, disclosures pointed to consolidated filings and statutory statements most people can't parse. 3 days earlier in our story, the family's agent had pitched a new fixed annuity from a household name carrier now aligned with a global asset manager. The brochure was crisp. The rate looked better than a bank CD. The guarantee sounded the same as before. There was no mention that the asset mix would tilt private, that a Bermuda affiliate might reinsure the policy, or that affiliated parties might collect fees along the way. None of that is illegal. It's just material to understanding the engine. This was the moment everything changed, when asset management fused with insurance manufacturing, and premiums became the fuel for a vertically integrated credit factory. If you own the inflow and the outflow, you don't wait for the market, you build it. The question is whether the safety net you promised can stretch as far as the factory wants to go. Apollo x Athene, the prototype. To understand how premiums became fuel, start with a blank balance sheet and a simple idea. In 2009, as low rates settled in, Apollo didn't just court insurers as clients. It helped build one, Athene. The job was clear: gather annuity liabilities at scale, then point the assets toward credit Apollo understood and could originate. Instead of raising a new fund every few years, they'd tap a river of premiums every day. Factual anchor. Athene evolved into Apollo's core permanent capital platform, materially stabilizing fee income and linking origination capacity to insurance inflows. Athene began by buying closed blocks of fixed annuities that legacy insurers were eager to sell. Those sellers wanted relief from old guarantees that no longer penciled in a near-zero world. Athene took the liabilities, often reinsuring them to affiliates in Bermuda, where capital treatment could be lighter for certain assets and hedging. That unlocked reserve credit in the U.S. and freed room to invest. Back at Apollo, a pipeline waited: private placements, asset-backed credit, slices of securitizations, and direct loans. The machine found its rhythm: liabilities in, credit out. Meanwhile, Athene grew from a deal-by-deal acquirer into a manufacturer. It didn't just buy old books, it sold new annuities through banks and independent agents. Every policy added to the permanent capital base Apollo could lean on. Over time, Athene swelled to a staggering share of Apollo's total assets under management. At corporate presentations, permanent capital stopped being a buzzword and became the backbone. Fees stabilized, volatility smoothed. The firm's identity shifted. Private equity shop, yes, but with an insurer's balance sheet at the core. Governance lived in the gray area where alignment meets conflict. On one side, the insurer owed policyholders best execution. Invest prudently, diversify, protect liquidity. On the other, the asset manager owned origination channels and could steer affiliated product into the insurer's portfolio. If the deal was arm's length and fairly priced, both could win. But the incentives weren't symmetric. The asset manager collected fees on assets regardless. The insurer bore credit and liquidity risk over decades. Boards, committees, and disclosures carried that tension year after year. Bermuda sat at the center of the loop. By reinsuring blocks to Bermuda affiliates, Athene could apply a different solvency model that, in some cases, recognized diversification and hedging benefits more favorably than US RBC. That's not a loophole in the illegal sense. It's a regulatory choice recognized by equivalence frameworks. But in practice, it lowered the capital cost of owning certain private or structured assets. With reserve credit recognized stateside, US entities looked stronger, even as risk and modeling moved offshore. Critics called it the Bermuda Triangle for a reason. Assets, liabilities, and capital ratios didn't line up cleanly on one page. On the street, results trumped debates. Athene's earnings were driven by spread, investment yield minus crediting, and hedging costs. Apollo's fees rose with AUM and performance. The flywheel turned. Strong spreads enabled competitive crediting rates to attract more policies, which funded more origination, which generated more fees and more spread. Each quarter that delivered smooth numbers validated the model. Analysts took notes. Competitors took action. Here's where the copycats enter. Blackstone, seeing the Athene engine, lined up insurance partners and reinsurance platforms to secure mandates for its private credit and real assets. KKR acquired Global Atlantic, knitting together origination with an insurance base of its own. Traditional insurers signed long-dated investment agreements with alternative managers to access origination they couldn't build in-house. Before long, the market had a new center of gravity. Life insurers as cornerstone buyers of private credit, with alternative managers as both suppliers and stewards. Inside Apollo, Athene didn't just diversify revenue, it changed risk. The firm could underwrite loans with the knowledge that a captive, long-duration buyer existed. That enabled larger, bespoke transactions, aircraft finance, equipment ABS, consumer receivable pools, investment-grade private credit with negotiated covenants. Each came with fees at multiple nodes: origination, warehousing, securitization, and asset management. When those assets landed at Athene, the insurer captured net interest spread too. Heads, I win on fees. Therefore, I also win on spread. But there was one problem that never left the room: time. Athene's liabilities last decades. Apollo's scorecard resets each quarter. Even with common ownership, that mismatch pushed on governance. Should Athene accept more illiquidity for extra spread if surrender behavior is stable? Until it isn't? Should it lean into mezzanine tranches that model well but are thinly traded? Should it depend on Federal Home Loan Bank lines as a liquidity buffer for assets that can't be sold fast at fair value? Each question had a spreadsheet answer and a human consequence. Meanwhile, regulators and ratings analysts watched the prototype scale. State commissioners probed affiliated investments and reinsurance disclosures. The NAIC revisited risk-based charges for CLOs and private credit. The Federal Insurance Office warned about concentration in offshore reinsurance hubs. Ratings agencies centered reports on asset liability matching, liquidity stress testing, and the expectation, never a guarantee, of sponsor support in a pinch. Apollo defended the model: higher quality private credit, matching of cash flows to liabilities, strong hedging of rate risk, and diversification by sector and borrower. In calm water, the arguments held. The family from our opening never heard the term permanent capital. What they felt was the downstream effect: a new annuity offer with a slightly higher teaser rate, a longer surrender schedule, and a contract booklet twice as thick. Buried in statutory filings was a note about reinsurance ceded to a Bermuda affiliate and a growing share of assets in private placements managed by an affiliate. The check still arrived, until 1 month it didn't, during a transfer window. Service apologized. The balance sheet kept compounding. Athene became the proof of concept that turned into a template. Billed or by the insurer, route liabilities through reinsurance that optimizes. Capital, originate credit inside the house, and feed the assets back to the balance sheet. Repeat at scale. Wall Street applauded the efficiency. Policyholders lived with the complexity. And before long, another giant wanted its own pipeline. While Apollo's prototype gathered momentum, Blackstone built something quieter, but just as ambitious. A conveyor belt that fed insurer premiums into its credit and real assets complex. The public message was partnership, not ownership. But the effect was the same. Control the asset side, secure long-dated mandates, and let fee streams ride on top of insurance spread. Factual anchor. Mandates emphasized investment-grade private placements, infrastructure debt, asset-backed finance, and private CRE. Assets designed to match long-dated liabilities while boosting spread versus public bonds. It began with strategic stakes and anchor mandates. Blackstone didn't always need to buy the insurer outright. It could take a minority position, provide capital solutions, and in return, win the right to manage large slices of the general account. That access was gold. Instead of hunting for fickle fund capital, Blackstone could plan origination around predictable premiums, lining up assets that fit insurer constraints while still boosting yield. Unknown to many policyholders, reinsurance platforms were the bridge. By channeling liabilities through affiliates, often Bermuda-based, partner insurers could unlock reserve credit at home, lighten capital on selected asset classes, and scale their allocation to private credit. Blackstone stood ready with product. Investment-grade private placements, infrastructure debt with long contracts, asset-backed deals secured by aircraft, autos, or equipment, and private commercial real estate loans. If banks hesitated, Blackstone stepped in with bespoke structures that insurance mandates could absorb. While that was happening in boardrooms, retail distribution was shifting. Fixed annuities, especially fixed-rate and indexed variants, were pitched as safe income during market turbulence. Bank channels and independent agents found traction with simple stories. Guaranteed floors, headline rates, steady checks. Behind the scenes, those inflows supercharged Blackstone's deal pipeline. The more premiums arrived, the more the firm could originate, warehouse, tranche, and place into captive mandates. The cycle reinforced itself. Here's where the fee stack compounded. Blackstone could earn base and performance fees as the appointed asset manager, plus economics from origination, securitization, and syndication. If an affiliated deal moved from warehouse to ABS to insurer balance sheet, each step carried its own take. The insurer captured the net interest margin. Blackstone captured repeatable fees. Heads the manager wins. Therefore, even when spreads compress, the flywheel keeps spinning on volume. But there was one problem sponsors rarely emphasized: opacity. Public bonds publish marks every day. Private loans don't. As partner insurers shifted from Treasuries and agency MBS toward private CRE debt, infrastructure loans, and bespoke ABS, valuation moved from market to model. That isn't inherently risky if your models are conservative and your liquidity is real. It becomes fragile when surrender behavior or policy loans tick up and you need cash fast. You can't just unload in a liquid tranche on a Tuesday afternoon. To bridge that gap, the industry leaned on funding lines. Federal Home Loan Bank advances, repo against eligible collateral, and committed facilities became essential parts of the liquidity plan. Blackstone's partners used them prudently, but reliance grew with the share of illiquid assets. If several insurers needed the same backstops in a stressed week, costs would rise and capacity might tighten. Ratings agencies started writing about it: asset liability management, liquidity stress tests, and the importance of sponsor access to markets. Meanwhile, something else was happening in the asset mix. The definition of investment-grade private credit stretched. Negotiated covenants looked strong on paper, yet refinancing risk built as maturities clustered. Commercial real estate cracks, especially in offices, required more hands-on workouts. Consumer ABS tied to autos or point-of-sale receivables looked solid until delinquencies climbed in weaker vintages. Each exposure was manageable alone. Correlated across insurers with similar managers, They formed a pattern you couldn't see from one statutory filing. Blackstone pushed back on the criticism. They argued their origination platforms were built for insurer needs. Long-dated cash flows, senior positions, structural protections, and diversification by sector and geography. They highlighted infrastructure debt backed by contracted revenues and residential credit tied to essential housing. They pointed to risk controls, independent valuation, and conservative leverage. In quiet markets, those points held. Spreads were better than public bonds, crediting rates looked competitive, and partner insurers reported steady results. From a policyholder's view, the story stayed simple: a contract, a rate, a surrender. Schedule. But buried in the annual statement, the composition changed, less in public corporates, more in private placements and affiliated ABS. Servicing remained smooth until it didn't. During reinsurance transfers, call centers read scripts about temporary adjustments. Checks were delayed a week here, 2 weeks there. The money wasn't gone. The machine was retooling. The real shift was strategic. By entrenching as a core manager for multiple insurers, Blackstone became a gatekeeper for which loans got made. If an originator knew there was an insurer mandate ready to buy, they could finance projects banks wouldn't touch under today's rules. That helped fill a lending gap and concentrated power. Pricing, documentation standards, and marks traveled through the same ecosystem. When news rattled the private credit market, share prices of the big managers wobbled together. Anxiety in one corner, an office loan workout, a high PIK rate, a stalled ABS takeout, echoed across the group. According to regulators and the Federal Insurance Office, the concern wasn't any single asset. It was the web: offshore reinsurance transfers, affiliated mandates, opaque valuations, and the scale of private credit now resting on insurance promises. State commissioners pressed for better look-through. The NAIC revisited capital charges on CLOs and structured credit. The Bermuda Monetary Authority floated enhancements to model governance and liquidity testing. Complexity adapted. Disclosure crept. Blackstone's pipeline didn't slow. Demographics favored annuity inflows. Pension risk transfers offered new blocks to manage. As long as premiums flowed, the conveyor belt ran. Reinsurance, mandates, origination, fees spread. For families, the guarantee still read the same. The difference sat underneath, in assets that needed time, confidence, and stable funding to do what they promised. Inside the asset mix shift. While that conveyor belt kept humming, the contents on the belt changed. What used to be treasuries, agencies, and big, boring corporate bonds morphed into a stack of private and structured paper that doesn't trade on a screen. The headline said investment grade, but the guts were different. Direct loans to mid-sized companies, mezzanine slices of CLOs, asset-backed deals tied to cars, equipment, credit card receivables, even tech subscription streams. A growing share came from affiliated desks inside the same sponsor ecosystem. Promise: if managed with real look-through, these instruments can match long liabilities and lift crediting rates without chasing public market volatility. Get this, the shift wasn't random. It was engineered to keep yield up while appearing safe on capital. Insurers moved from liquid, mark-to-market assets to privately negotiated loans and tranches with more spread. They added mortgage servicing rights that pay when borrowers keep paying. They bought stakes in aircraft and rail finance pools with long contracts. They leaned into non-performing loan packages that could be worked out over time. In commercial real estate, they financed apartments, warehouses, and more carefully, offices. Each piece offered extra basis points. Together, they built a book that looked calm until someone needed cash quickly. Meanwhile, something else was happening behind the curtain. Risk was getting repackaged. The sponsor-originated loans, warehoused them on short-term credit, sliced them into tranches, and sold the pieces down the line, often into insurers tied to the sponsor by mandate or ownership. That's originate to insure. It's efficient, but it comes with a question. Who sets the price when the buyer and seller share a roof? Best execution for policyholders depends on real arm's-length checks. In private markets, those checks are harder to prove. Duration games added gloss. Insurers have long-dated liabilities, so they sought assets with similar cash flow profiles. Private loans with call protection, infrastructure debt with contracted revenues, ABS with expected amortization. All of it helped match the book. But optionality cuts both ways. Callable features can shorten duration at the wrong time. Extension risk can push it out when rates move. In structured credit, convexity gets quirky fast. Models map the world. Behavior writes the last chapter. Liquidity sat at the center. A plain vanilla bond can be sold in a bad week at a price you may not love, but you can see. A bespoke loan? You call brokers, lean on lines, or wait. That's why reliance on Federal Home Loan Bank advances and repo rose as the mix shifted. Those tools buy time. They also build an expectation that rolling short-term funding against long-term, illiquid assets will always be there. It usually is, until the week it's not. Mark-to-model became the norm. With fewer observable prices, valuation committees took over. Independent reviews help, but inputs matter. Covenant cushions, loss assumptions, prepayment speeds, refinancing probabilities. Each knob is a judgment call. When the private credit market is calm, models rhyme with reality. When defaults tick up or refis stall, marks lag. Earnings look smooth, then catch up in a hurry. And then there's concentration you can't see from one filing. One insurer might own a slice of a warehouse ABS deal, another might hold the mezz of a related securitization, and a third might finance the warehouse itself. If the same sponsor arranged all three, the ecosystem shares the shock when a pool underperforms. The names on the policyholders' envelopes are different. The assets under the hood rhyme. From the family's perspective, it shows up as small frictions that hint at a bigger machine. A slightly higher teaser rate paired with a longer surrender schedule. A disclosure about affiliated investments that feels like boilerplate. A customer service note during a reinsurance handoff that reads like a script. Nothing breaks. But when they ask, what exactly backs this promise? The answer lives in a stack of private term sheets they'll never read. Insiders will say, with some truth, that the new mix is still conservative on a risk-adjusted basis. They'll point to senior secured positions, hard collateral, tight covenants, and diversification across thousands of borrowers and assets. They'll note that public markets can be volatile and that private loans, held to maturity, can deliver steady cash flows that suit insurers better than twitchy bonds. They'll add that rating agencies now haircut and stress test these holdings, requiring liquidity ladders and playbooks for surrender spikes. But there was one problem those defenses didn't solve: the cycle. When rates jumped, some private borrowers faced ugly refis. Payment in-kind toggles crept higher. Commercial real estate, especially older offices, needed restructurings. Consumer ABS in weaker vintages saw delinquencies climb. Each pocket was manageable in isolation. Correlated across mandates and reinsurers tied to the same sponsors, the private calm masked shared weather. Meanwhile, the originate-to-insure loop kept pushing product toward captive buyers. Warehouse lines needed takeouts. New deals fed fee targets. The algorithmic target inside many insurers. EarnX spread above cost of funds. Nudged asset teams toward mezz and illiquids when safer spreads compressed. Nobody wrote "take more risk" in an email. The model did the whispering. Ratings reports began reading like translations of that whisper. Focus on asset liability management, they said. Watch surrender behavior. Monitor FHLB reliance. Understand affiliated exposure and look through to underlying collateral. Assume sponsor support is helpful, but not guaranteed. Regulators circled the same ground, especially on offshore sessions and structured credit capital charges. The disclosures improved, but complexity sprinted faster. For the family, the takeaway was plain. The promise is still a promise. The path to keeping it now runs through assets that need time, stable funding, and strong governance. When the check is late by a week during a transfer window, it's a reminder that behind the envelope sits a balance sheet that traded glass-clear bonds for modeled loans. In good weather, that trade feels brilliant. In heavy weather, it demands faith, and a lot more questions. The Bermuda reinsurance loop. While the asset mix was shifting, the real accelerant lived in a legal document, a reinsurance treaty that moved liabilities offshore. Here's how the loop works in practice. A U.S. life insurer cedes a big block of fixed annuities to a Bermuda affiliate under common control. On day one, reserves and future promises slide to the Bermuda balance sheet. Back in the U.S., the ceding company books reserve credit, which instantly frees capital. Capital freed at home means room to invest more, report stronger ratios, and grow faster. Factual clarity: Bermuda's regime is internationally recognized. The arbitrage critics cite is lower capital intensity for certain risks and model-based recognition of diversification and hedging. Why Bermuda? Its prudential regime is recognized internationally and isn't a free-for-all. But its solvency framework, which incorporates internal models and recognizes diversification and hedging differently than US RBC, can treat certain assets and risks more favorably. That's the regulatory arbitrage critics' point too. Not law-breaking, but a choice of venue where the same risks cost less capital. When your spread depends on how much capital you tie up, moving liabilities to a place that prices capital lower is powerful. On paper, everyone wins. The US insurer improves its risk-based capital and looks safer to policyholders and regulators. The Bermuda reinsurer, sharing the same corporate umbrella, applies models tailored to the portfolio it holds, often heavy in private credit, structured assets, and affiliated deals. The group's consolidated economics look great, but something subtle changes. The risk that backs your promise now lives under a different rulebook, with disclosures that don't land neatly in your state's public filings. Meanwhile, something else is happening in the assets. Once liabilities are in Bermuda, the reinsurer can buy the kinds of loans and tranches the sponsor originates. Because the reinsurer is part of the same corporate family as the asset manager, affiliated transactions crop up. Best execution policies are supposed to police pricing and terms, but in private markets the guardrails are mostly internal. Bermuda's supervisors do examine these structures, yet the look through a retail policyholder can access is thin. This was the moment everything changed for capital efficiency. The loop created leverage without calling it leverage. Reserve credit booked in the US reduces statutory capital strain. The Bermuda entity holds the risk on a model that often assigns lower charges to a liquid but investment-grade private credit. The group can then scale origination and asset purchases faster than if every dollar of liability stayed onshore under US RBC. When multiplied across multiple blocks and affiliates, it's a quiet flywheel. Regulators noticed. State insurance commissioners convened hearings and work streams to examine captives, affiliated reinsurance, and cross-border capital treatment. The NAIC reworked factors on CLOs and started tightening scrutiny of structured and private assets. The Federal Insurance Office flagged concentration in Bermuda sessions and the opacity that follows. The Bermuda Monetary Authority, for its part, proposed enhancements to its regime and published guidance to bolster comfort. Each step improved pieces of the puzzle. None delivered a simple, public map from your policy to its ultimate assets. Ratings agencies adapted their playbooks. Reports began leaning on three pillars: asset liability matching, liquidity under surrender stress, and the likelihood, never a certainty, of parental support for offshore affiliates. Analysts asked whether funding lines and Federal Home Loan Bank advances could cover spikes in policy loans or surrenders without forcing sales of illiquid positions. They asked how basis risk shows up when bespoke private loans don't hedge cleanly against interest rate swings. They asked about affiliated exposures that tie the insurer's fate to its manager's pipeline. Urgency. The answers here determine whether a transfer delay is a hiccup or a headline. What nobody saw clearly at first was concentration risk building across the ecosystem. Different insurers ceded to different Bermuda entities, but many of those entities bought from the same origination shops, financed warehouses with the same banks, and tapped similar securitization channels. If refinancing walls rose in private credit, or if commercial real estate needed widespread workouts, the marks and liquidity needs could rhyme across multiple balance sheets at once. That's not a single counterparty problem, it's a network problem. Defenders of the loop make a fair point. Reinsurance has always moved risk to where it can be best managed, and Bermuda is a serious jurisdiction with real oversight. They add that long-dated liabilities align naturally with private assets that throw off stable cash flows, and that sophisticated hedging can tame interest rate exposure. They note that policyholders are still protected by state guarantee associations if a U.S. entity fails, regardless of offshore treaties. All true within limits. Here's the catch. Guarantee coverage has caps and delays. Resolution mechanics assess surviving carriers, which can spread stress. And if the bulk of an insurer's earning power depends on assets sitting in an offshore affiliate with limited public look-through, your confidence rides on boards, models, and management culture you can't audit. When checks are late during a transfer window and call centers cite temporary adjustments, it's the surface ripple of a deep, complex loop. For families, the practical telltales are small but traceable. Rapid annuity growth paired with notes about reinsurance to unauthorized affiliates in statutory filings. Rising percentages of affiliated investments in the investment schedule. Increased reliance on FHLB advances. Ratings commentary that emphasizes liquidity and ALM over plain surplus. None of those are smoking guns. Together, they sketch the Bermuda reinsurance loop at work. The loop isn't a scandal. It's a design choice that maximizes spread by minimizing capital friction. In calm seas, it sails fast. In rough water, it demands trust, in the models, in the managers, and in regulators stitching two regimes together. And trust is hardest to price the moment the rate shock needs liquidity most. Then rates jumped. Not gradually, fast. In 2022 and 2023, the cheapest money in history vanished, and every balance sheet built for low rates had to show its work. For PE-linked insurers, this wasn't an abstract chart. It was a live-fire drill on three fronts: market value, liquidity, and behavior. Promise. If the model truly matches long assets to long promises with conservative liquidity, it should bend, not break. This was the first real test. First, the marks. As yields spiked, the value of existing fixed-income assets fell. Public bonds showed it instantly. Private loans didn't move on a screen, but the math still bit. Models had to update discount rates. Some assets hedged rate exposure, but bespoke credit doesn't hedge like a Treasury future. Basis risk showed up in small mismatches that turned into real dollars. On paper, these were unrealized losses. In practice, they narrowed room for error. Meanwhile, policyholders changed their behavior. Surrender requests and policy loans ticked up as CDs and money markets suddenly offered attractive yields with no strings. Annuities sold in a low-rate world looked less special next to 5% cash. In normal times, surrender penalties and market value adjustments slow the exit. But when a family needs funds, or sees a better headline rate, calls still come in. Insurers had to either sell assets or find cash somewhere else. Here's where funding lines took the stage. Federal Home Loan Bank advances became a pressure valve. Pledge eligible collateral, get liquidity, avoid dumping illiquid assets at bad prices. Repo markets helped too, but capacity isn't infinite. If multiple carriers leaned on the same backstops at once, costs rose. Ratings analysts started asking pointed questions. How much FHLB capacity is left? What collateral qualifies? What happens if those lines tighten on a busy week? At the same time, parts of the private credit book hit their own weather. Refinancing walls loomed for loans underwritten in the low-rate era. Payment in-kind features, meant as a bridge, got used more. The lever didn't break the system, but it signaled pressure. In commercial real estate, office values sagged, and borrowers needed time, equity, or both. Consumer ABS tied to autos and weaker credit cohorts saw delinquencies rise from historically low levels. Each issue was manageable alone. Correlated across similar mandates, they added friction. Inside the liability stack, hedges faced their own test. Insurers do hedge interest rate exposure, but hedging a book of idiosyncratic, privately negotiated loans isn't the same as hedging a Treasury ladder. Prepayment speeds changed. Optionality in ABS and callable loans behaved differently than modeled. Duration extension in some pools clashed with contraction elsewhere. The result was basis risk. The hedge protected one thing while the asset shifted in another way. For a spread business, those basis points matter. The pricing lens shifted too. New annuity buyers suddenly demanded more. To stay competitive, insurers had to offer higher crediting rates on fresh premiums. That helped bring in cash, but it also raised the cost of liabilities for years ahead. Spreads could be protected if asset yields kept up. That nudged portfolios further toward higher-octane private credit and structured tranches that promised extra pickup. Exactly when the cycle was the least forgiving. Distributions slowed in pockets. Banks, busy selling their own juicy CDs, pushed fewer annuities. Independent agents adapted, but the story had to change. Today's higher annuity rates looked better, yet surrender terms often stayed tight to avoid a rush out of legacy blocks. Some carriers lifted surrender charges or kept market value adjustments firm. It wasn't punitive, it was survival math. The family on hold with the call center heard about temporary adjustments, while Treasury teams watched collateral ladders by the hour. Service strains followed the money. Reinsurance transfers scheduled months earlier landed in a whipsaw market. moving assets, novating hedges, coordinating Bermuda and U.S. books. Each step got harder when prices gapped and liquidity thinned. Back-office timelines stretched. A check that once arrived on the 1st showed up on the 7th. The promise hadn't failed. The plumbing was groaning. Ratings agencies recalibrated their narratives. Reports leaned hard into asset liability management discipline, liquidity buffers under stress, and the role of FHLB and committed facilities. Analysts wanted to see stress testing that assumed elevated surrenders, clogged securitization exits, and partial hedge shortfalls. They asked about governance around affiliated deals when origination needed takeouts to keep warehouses moving. They reminded readers that sponsor support is helpful, but isn't a binding guarantee. Regulators used the moment. State commissioners intensified data calls on offshore cessions and affiliated investments. The NAIC advanced revisions to capital factors for structured assets and looked harder at how private credit was being risk-weighted. The Federal Insurance Office reiterated concerns about concentration in Bermuda and the broader tie between insurance promises and shadow banking pipes. Bermuda's supervisor proposed tweaks of its own. The perimeter tightened a notch. Inside firms, the talking points met reality. Executives emphasized that most holdings were senior, asset-backed, and matched to liabilities. They noted that private assets, held to maturity, would throw off cash just fine. They highlighted new origination at higher yields that would lift future spreads. Much of that was true, but the rate shock forced choices. Protect liquidity and accept lower near-term returns, or chase yield to backfill spreads and lean on models. Each choice left a fingerprint in disclosures. Higher FHLB usage, slower surrender credits, tweaking of crediting rates, more granular risk language. For policyholders, the signal was simple. Contract terms mattered more than slogans. Surrender windows, market value adjustments, and crediting rate resets carried real dollars. Service delays, even short ones, were tells that the balance sheet was busy. The stress test didn't collapse the model. It exposed how much of the promise depends on time, funding, and confidence when markets move fast. The check eventually arrived for the family we've been following. It cleared a few days late. No headlines, no crisis, just a small delay that pointed to a bigger truth. When rates jump, the new engine has to downshift on a steep hill. Whether it holds the road depends on how honestly the risks are marked, how conservatively the cash is managed, and how quickly the people in charge choose resilience over speed. Regulators, ratings, and red flags. Amid the rate shock, the people paid to worry finally did. State insurance commissioners called data drills on captives and cross-border treaties. They wanted names of affiliates, sizes of cessions, asset look-throughs that didn't stop at private placement. In hearing rooms, staff asked simple questions that had complicated answers. Where exactly are these liabilities? What collateral backs them? Who sets the marks when the buyer and seller share a parent? Solution preview. Regulators pushed for tighter capital on structured assets and better look-through. You can borrow their checklist to protect yourself. While that was happening in New York and Des Moines, the NAIC moved its levers. Capital factors on structured credit, especially CLOs and Bespoke ABS, went under the microscope. Drafts circulated that would raise required capital for tranches whose risk had been underweight. Affiliated investments got more scrutiny too. The message was steady, not loud. If you want higher spread with private complexity, you'll carry more capital against it. Over in Washington, the Federal Insurance Office sharpened its tone about offshore reinsurance. The concern wasn't Bermuda's seriousness, it was concentration and opacity. Too many liabilities migrating to the same jurisdiction, too much reliance on internal models tied to affiliated asset managers, and too little public look-through for consumers deciding where to place lifetime savings. The phrase shadow banking slipped into official language. Insurance promises increasingly funded by private credit pipes that sit outside bank regulation. Bermuda's supervisors didn't sit still. The Bermuda Monetary Authority proposed enhancements, from model governance to liquidity stress testing, aiming to reassure counterparts that the island's prudential net was tight. Industry applauded the pragmatism. Keep the capital flexibility that makes reinsurance work, bolster the guardrails that comfort skeptics. It was a diplomatic dance across an ocean of statutes. Meanwhile, rating agencies AM Best, S&P Moody's, Fitch updated their scorecards. Reports leaned on three pillars. First, asset liability management, duration matching, optionality, and how basis risk in private assets is really hedged. Second, liquidity. Playbooks for surrender spikes, collateral ladders for FHLB and repo, and contingency plans if securitization exit doors narrow. Third, governance around affiliates, best execution policies, independent valuation, and the willingness to say no when the pipeline wants to take out the balance sheet shouldn't buy. They also added a quiet fourth pillar, the expectation of sponsor support. In stress, would the asset manager inject capital, backstop a warehouse, or buy paper from the insurer to ease pressure? Sometimes yes, but agencies reminded readers that strategic importance isn't a binding guarantee. It's a judgment call made in the thick of a storm. On the ground, consumer protection looked less like a blockbuster case and more like a string of memos. State departments issued bulletins reminding carriers to communicate clearly during reinsurance transfers, credit interest accurately, and honor processing timelines. They asked distributors to present annuities fairly, headline rates, surrender terms, riders, and risks, without burying affiliated relationships. They fielded complaints about delayed checks and opaque disclosures, then nudged, fined, or required remedial plans. Political pressure simmered. Senators and advocacy groups framed the issue as simple. Private equity controls insurers, shifts assets to opaque loans, and extracts fees while policyholders shoulder tail risk. Industry countered with its own simple line. Insurers fund the real economy with long-term capital, match liabilities with cash-yielding assets, and diversify beyond volatile public markets. Both stories contain truth. The tension lived in the plumbing, not the slogans. Here's where the red flags matter for regular people. You won't read an internal model, but you can spot signals. Rapid annuity growth outpacing peers, especially if paired with notes about reinsurance to unauthorized affiliates or Bermuda captives in statutory filings. Rising percentages of affiliated investments, assets managed by or bought from related parties, without much detail on pricing or oversight. Heavy reliance on Federal Home Loan Bank advances or other short-term facilities in the liquidity footnotes, especially if usage trends higher across quarters. Ratings commentary that shifts from simple surplus strength to repeated focus on ALM, funding profiles, and the role of sponsor support. Product terms that quietly lengthen surrender periods, keep market value adjustments tight, or offer teaser crediting rates that drift lower after the first year. Advisors face their own mirror check. Commissions on fixed annuities are real. So is fiduciary duty. Good advisors began asking for asset look-through. What share is private credit? What slices of CLOs or ABS? What's the affiliated exposure? And where are the liabilities reinsured? They pushed carriers for plain English answers on liquidity plans during stress. When answers came thin, they steered clients toward simpler products or mutual insurers with conservative ALM and fewer affiliated ties. One more flag sat in plain sight: disclosures that arrive late and read dense. Complexity thrives in lag and jargon. If it takes a financial analyst to tell you what backs your benefit, you're not the customer, you're the funding source. Back at our family's kitchen table, the lesson was practical. The call center can't explain RBC ratios or Bermuda's internal models, but the red flags show up in the policy packet and the insurer's public filings. If the carrier grew fast, seeded big blocks offshore, leans hard on private assets managed by its parent, and finances liquidity with FHLB lines, you're buying a promise that depends on a complex web holding together. That may be fine. It may even pay a bit more today. It also asks you to trust people and processes you'll never meet. Regulators can close gaps. Ratings can warn. But the cleanest protection, for now, is choosing where you place your promise with open eyes, and knowing which yellow lights mean slow down, not speed up. Who profits, who pays? Follow the money, and the picture sharpens. Sponsors, the alternative asset managers steering these insurers, win in almost any weather. When premiums land, they collect management fees for investing them. When they originate loans, tranche deals, and securitize pools, they collect manufacturing fees. When those same assets live on insurer balance sheets for years, the spread keeps paying. If marks wobble, fee lines tied to AUM keep humming as long as assets stay in-house. Heads, they win on fees. Therefore, even in tougher markets, the engine still throws off cash. Promise versus payoff. Families get guarantees. Sponsors get recurring economics. The gap is closed only by governance, liquidity, and conservative marks. Executives inside the ecosystem do well too. Compensation tilts toward growth, bigger mandates, higher return on equity, larger origination volumes. Bonuses scale with AUM and spread, not with whether a retiree's check posts on day one. The timeline mismatch is baked in. Quarterly scorecards versus multi-decade liabilities. There are governance committees, clawbacks, and risk limits. But the scoreboard most people chase is velocity, how fast the flywheel spins. Distributors aren't shy about incentives either. Fixed annuities pay real commissions. Safe income is an easy story in volatile markets. Independent agents and bank platforms push volume because the headline rate and the word guarantee do the work. Few brochures mention affiliated origination or offshore reinsurance. They don't have to. The sale lives where trust and a printed rate meet. So who pays? Start with policyholders. They shoulder the quiet tail risks of opacity and complexity. They accept surrender schedules that trap them if better rates appear or life happens. They live with crediting rates that can reset. Lower, riders that cost more than they use, and service delays during reinsurance handoffs. They fund an asset mix they can't see, priced by committees they'll never meet, tied to liquidity lines they don't know exist, until a call center reads a script about temporary adjustments. They also pay through optionality tilting against them. Teaser rates that fade. Market value adjustments that bite on exit. Riders that sound comforting but complicate claims. Each term is disclosed, but not in a way most families can triangulate against the machinery underneath. When stress hits, these frictions do their job. They slow exits and protect the balance sheet. That's rational for the institution. It's costly for the person who needs cash now. Taxpayers sit farther back in the theater, but still in the blast radius. When an insurer fails, state guarantee associations step in, up to caps that vary by state and product, and then assess surviving carriers to refill the pot. Those costs pass through over time in pricing and availability. A big enough failure ripples through peers who did nothing wrong. If multiple carriers stumble together, political pressure rises for broader backstops. Nobody calls it a bailout. It looks like assessment mechanics. The bill still lands somewhere. There's another group paying in a way that's hard to see. Future retirees whose pensions moved in pension risk transfers. When a corporate plan offloads liabilities to an insurer connected to this model, retirees lose the federal PBGC backstop and step into a state guarantee world with caps and uneven coverage. If the insurer thrives, benefits continue as promised. If the cycle turns and a highly concentrated system wobbles, retirees discover the difference between federal and state safety nets the hard way. Meanwhile, the ecosystem concentrates power. When insurers become captive buyers of affiliated private credit, origination standards follow the needs of mandates. Pricing lives inside the house. Marks travel with relationships. If a warehouse needs a takeout, the insurer's mandate becomes the exit. In good times, that's efficiency. In bad times, it's a closed loop that can't clear without real cash. Policyholders fund the loop by design. They're downstream from choices they didn't vote on. Sponsors will argue they also pay reputation risk, capital support, and the grind of managing through cycles. Sometimes they do write checks to stabilize affiliates. Sometimes they buy assets back or backstop a facility to steady funding. But those are discretionary acts, weighed against shareholder priorities and opportunity costs. The legal promise is to shareholders. The moral promise is to policyholders. The structural promise is to the model. In a hard week, only one of those is binding. What makes this lopsided is information. Sponsors and executives have dashboards, collateral ladders, duration maps, stress trees. Distributors have rate sheets and commission grids. Regulators and raters have data calls and committee rooms. Policyholders have a contract and a phone number. The people with the least visibility carry the irreducible risk of time, waiting for payments, trusting the marks, hoping the lines hold. The profits show up as smooth earnings, rising fee lines, and celebratory quarters when origination hits targets. The costs show up as surrender penalties, delayed checks, and the quiet anxiety of not knowing what sits behind a promise you need to live. In the end, the spread has to come from somewhere. Today, it comes from complexity priced just low enough to look safe, and from families willing to trust a system. A policyholder's out of the sunlight. They bought it in 2007, before any of these terms, private credit, Bermuda session, meant anything to them. Mark was 58, a mechanic with steady hands. Elena taught 4th grade, and clipped grocery coupons into neat stacks. A bank advisor slid a brochure across the desk. A fixed annuity with a guaranteed rate, backed by a century-old insurer. "Set it and forget it," he said. They wrote a check big enough to make Mark's palms sweat and walked out believing they'd solved retirement income. For years, it did what it promised. Interest credited on the same date each month. Statements printed in calm fonts. The insurer's name, familiar, almost paternal, sat at the top like a seal. When the 2008 crash rolled past, their account didn't flinch. The guarantee felt like armor. Then slowly, the labels changed. A letter announced that their insurer had entered into a strategic transaction, moving certain policies to a new affiliate. "Your benefits won't change," it read. Legal names shifted. A footnote mentioned reinsurance. They didn't notice the part about the reinsurer being based offshore. Why would they? The checks still posted. A year later, another envelope arrived. Same logo, new tone. "We're excited to partner with a world-class asset manager to enhance long-term value." Mark raised an eyebrow. Elena filed it under good news. Neither of them knew that the portfolio backing their contract was tilting away from Treasuries and into loans they'd never see. They didn't know what affiliated investments meant or why a Bermuda regulator cared about their grocery money. When rates fell and stayed low, their crediting rate edged down. The call center explained it politely. New money rates are different in this environment. Their surrender schedule, 10 years long at the start, had shortened to 2, but the market value adjustment language could still bite if they exited at the wrong time. They chose to wait. Patience had always paid them. Then came 2022. Their daughter's roof sprang a leak, and Mark wanted to help. They called to ask about a partial surrender. The rep walked them through options, then paused. There may be a brief processing delay due to a reinsurance transfer. The words landed flat. "How long?" Elena asked. "A week, maybe 2. They waited. The roof got a tarp. Meanwhile, a friend at church mentioned that his brother worked at a ratings agency. "He says your company's fine," the friend offered. "Just complicated." Mark laughed softly. Everything felt complicated now. He pulled their latest statement and read the line that had never caught his eye. "Reinsurance ceded to unauthorized affiliate, reserve credit recognized." Unauthorized sounded ominous. The footnote explained that unauthorized just meant not licensed in this state. Comforting in a legal sense, not in a kitchen table sense. They asked their advisor to explain the asset mix. He sent a glossy one-pager. Investment-grade private placements, asset-backed securities, infrastructure loans. "These are safe," he said. "Boring, even." Mark thought about boring, his favorite word for money. He wondered why boring needed 4 footnotes and a map of the Atlantic. When the check finally arrived, it covered the roofer's deposit. The delay felt small and enormous at once. Elena wrote in her planner, "Call insurer earlier next time." She also wrote a question to ask. What % of assets are affiliated? How much reinsured to Bermuda? She didn't expect simple answers. She wanted to hear the rep try. They explored moving the money when the surrender window opened. 2 options emerged. First, ride it out. The contract still guaranteed a base rate, and newer money was crediting better as yields rose. Second, transfer to a simpler product at a mutual insurer with conservative ALM and no offshore sessions. The transfer would trigger a fresh surrender schedule and a modest drop in headline rate. Safety versus simplicity. Return versus comfort. They learned about state guarantee associations, the backstop nobody mentions on sales day. In their state, the cap on annuity protection was generous, but not unlimited. They discovered that coverage attaches to residents, not policies, and that delays in a failure could stretch months. They looked up their carrier's AM Best rating trend and saw a stable outlook with notes about liquidity and asset liability management. They didn't read the whole report. The summary was enough. Fine today, watch the plumbing. At a kitchen table meeting, their advisor, prodded by Mark's questions, admitted the ties to a big-name asset manager. "It's common now," he said. "They've got scale." He also admitted the commissions on the products he'd sold them. Elena appreciated the honesty. She asked for 3 documents: the statutory statement Schedule D for affiliated investments, a summary of reinsurance sessions by jurisdiction, and a plain English liquidity plan for surrender spikes. He promised to ask. She set a calendar reminder to follow up. They chose a middle path. Keep the old annuity until the surrender clock ran out, then ladder new money across 2 carriers, one mutual, and one with minimal offshore reinsurance. They kept 6 months of expenses in cash to avoid calling a call center during a transfer week. They wrote down the questions they'd ask before buying any policy again. Who manages the assets? How much is private credit? How much is reinsured to Bermuda? What's your FHLB usage? How did your crediting rate move in 2022? On a Sunday night, Mark sat with a cup of tea and said, "We didn't sign up for this much homework." Elena nodded. "We didn't, but we signed up for the check." The promise still mattered. The path to it had changed. They decided to keep walking, eyes open, questions ready. Pension risk transfer and the spillover. While Mark and Elena weighed their choices, a quieter shift was moving billions of dollars of promises with a single board vote. Corporations with old-school defined benefit pensions were tired of the volatility. So they signed a contract, wrote a check, and transferred decades of retiree payments to an insurer. It's called pension risk transfer. On paper, nothing changes for the retiree. The check still comes. The logo on the envelope just swaps from a company name to an insurer's. Factual anchor. This market has swelled into the hundreds of billions of dollars in obligations transferred, with large single deals cresting into the tens of billions. Concentration that pulls retirees into the same asset and reinsurance ecosystem as annuity holders. Here's where it matters. Inside a corporate pension, the federal PBGC sits in the background, a safety net funded by employer premiums, with rules and a track record. When a plan transfers liabilities to an insurer, that federal backstop steps off stage. Retirees move from PBGC's world to the state guarantee system. 50 versions of caps and coverage, varying by state and product. The promise doesn't vanish. It lives under different rules. Meanwhile, the same playbook we've traced in annuities slid into this market. PE-linked platforms and alternative managers, now fluent in insurance mechanics, showed up to bid for megatransfers. They offered pricing corporates liked and investment stories boards could accept. Long-term assets matched to long-term payments, with origination pipelines that banks couldn't match. The pipeline grew. Deals got larger. A handful of insurers became the destination for factory workers' pensions, hospital staff annuities, utility company promises. Distribution looked nothing like retail. There were no kitchen table brochures. There were consultants, actuarial memos, and board decks filled with discount rates and mortality tables. But the assets behind those promises rhymed with everything we've described: private placements, infrastructure debt, ABS, and increasingly, affiliated origination feeding insurer mandates. Reinsurance treaties bridged the books to Bermuda affiliates, unlocking capital relief to scale. The Bermuda Triangle wasn't a consumer footnote here. It was part of winning bids. Retirees felt the change in small ways. A letter arrived. Your pension will now be paid by insurer. Your benefit amount and schedule are unchanged. New call center. New portal. The first check posted on time. Then, in a stress week, a few payments landed a day late. Nobody was shorted. But the tone shifted from an employer's benefits office to a financial institution's script about processing windows. The promise had moved into an industrial machine. What nobody told the retirees plainly was how coverage works now. State guarantee associations cap benefits, often substantial, but not unlimited, and coverage depends on residency and product type. If a large failure hits, associations assess surviving insurers to pay claims. That takes time. The PBGC's centralized safety net is gone. In its place sits a patchwork that works, until it's asked to work fast at scale. From the corporate side, the choice still made sense. Offload balance sheet volatility, lock in a cost, focus on the core business. Boards asked insurers about ratings, liquidity, and investment strategy. They saw marquee names, some linked to global managers, and took comfort. Consultants ran diligence. Regulators reviewed transfers. Everything followed the rules. But the concentration risk crept in. More promises clustered at fewer insurers, many sharing asset pipelines, reinsurance hubs, and funding backstops. Meanwhile, the originate-to-insure loop bent toward pensions. Long, predictable cash flows are a perfect match for infrastructure debt with contracted revenues, long lease real estate loans, utility financing, and senior private placements. If an asset manager controlled origination and the insurer's mandate, the line from pensioner to project tightened. It's efficient until it's not. A refinancing wall, a CRE workout wave, or a clogged Securitization exit could strain liquidity at multiple insurers serving the same retiree populations. Regulators saw the map. The Federal Insurance Office called out the systemic angle. Pension promises migrating offshore via reinsurance, with look-through gaps for beneficiaries. State commissioners reminded bidders to disclose cessions and ensure service continuity. The NAIC nudged capital treatment on structured assets higher. Bermuda's supervisor padded governance and liquidity expectations. Each step was sensible. The network still concentrated. Here's a microstory inside this shift. A retired machinist, 72, opened a letter saying his monthly pension would now come from a different company. He called the old HR line out of habit. A recording redirected him to the insurer. "Will my check change?" he asked. "No," the rep said. "Same day, same amount." He asked what backed it. "High-quality investments," she said. He didn't ask about private credit, ABS, or reinsurance. He asked if the check would be there when his wife needed it. "Yes," she said. He hung up satisfied and a little older. On Wall Street, the spillover had another edge. As pensions moved, insurers' scale swelled, and so did managers' fee streams. A larger base meant more confidence to originate bespoke loans, to warehouse risk longer, to wait for the market to take out deals. It also meant that if sentiment flipped, if a high-profile private credit wobble hit headlines, the same names would face questions on multiple fronts. Annuity flows, pension servicing, funding costs. Correlation wouldn't be theoretical. For families and retirees, the action step is simple and unglamorous. If your pension transferred, learn your state guarantee cap. Keep the last employer's letter and the insurer's policy number in the same folder. If you move states, check coverage rules again. Ask the insurer one plain question. What portion of these liabilities is reinsured offshore? You may not love the answer. You'll know where you stand. The promise can still hold. It often does. But the stage has changed, from a federal backstop and diversified public bonds to a state patchwork and a web of private credit, reinsurance, and funding lines. When the check arrives, it feels the same. The route it took to get there is longer, faster, and harder to see. The yield machine, originate to insure. From the insurer's perspective, yield is oxygen. From the sponsor's perspective, yield is product. Put those together, and you get the quiet engine driving this era, originate to insure. It starts upstream, before a single premium arrives. On origination desks modeling the exact cash flows an insurer can hold, priced to the basis point that keeps spreads alive after fees, hedges, and capital charges. Urgency. When this choreography prioritizes warehouse takeouts over policyholder prudence, bottlenecks become your problem in a stress week. Vertical integration is the backbone. The same corporate family scouts borrowers, structures loans, and builds securitizations, then sets up mandates so affiliated insurers will be the end buyers. Think of it as a reserved lane on the highway. The origination team doesn't just hope the market will take the deal. It knows a captive balance sheet is waiting. That certainty changes everything: pricing power, documentation terms, and how much warehouse risk a firm is willing to carry while stitching a transaction together. Pre-commitment locks the loop. Investment guidelines at the insurer level are negotiated with the asset manager in mind. Minimum ratings, collateral types, duration bands, leverage limits. Within that box, origination teams design deals to fit like a glove. Senior tranches for the insurer, subordinate slices placed elsewhere, fees clipped along the way. When the deal closes, the insurer gets its net interest margin, and the manager gets recurring management income plus manufacturing economics. It's not a conflict by definition. It's a conflict by design unless best execution truly bites. Pricing becomes internal theater. In public markets, quotes flicker and force discipline. In private credit, valuation leans on models and comps assembled by the same ecosystem that created the paper. Independent valuation helps, but the gravitational pull is strong. If a captive mandate is the primary buyer, the clearing price can blur into a policy choice. That's especially true when warehouse lines need takeouts on a schedule and securitization windows aren't friendly. Warehouse to ABS to insurer is the choreography. Loans are originated and warehoused on short-term facilities, often with banks still in the story as lenders to the shadow bank. When portfolio size or market timing lines up, the pool is tranched and sold into an ABS or CLO. Senior pieces go to insurers hungry for long cash flows with familiar credit boxes. Mezz and equity land with funds willing to ride volatility. Each step throws off fees. If the securitization window shuts, insurer can act as the direct buyer, bypassing the bond market entirely and keeping the wheel turning. Conflicts live in the footnotes. Best execution policies, independent committees, fairness memos. These are meant to prevent self-dealing. But related party transactions are a feature here, not a bug. The same brand can stand on every side: originator, warehouse borrower, securitization sponsor, asset manager, and end buyer through the insurer mandate. When the stars align, everyone in the group wins. When they don't, the question is who eats the margin: the fund investors, the manager, or the policyholder's balance sheet that can't move fast. An algorithm hums beneath the story. Insurer targets are often framed as earned cost of funds plus X basis points, where cost of funds is the crediting rate plus hedging and admin. When public spreads compress, the model nudges teams toward assets with embedded yield, call protection, mezz tranches, esoteric collateral, or structures with tighter covenants but thinner liquidity. No one needs to say take more risk. The optimization function hunts it, subject to capital charges and ratings constraints. If capital rules are lighter in a Bermuda affiliate, the model's feasible set expands offshore. This is where capital arbitrage meets product manufacturing. Move liabilities to Bermuda, gain reserve credit at home, and invest in assets that score well under the island's solvency model. The group's reported return on equity lifts, and the insurer can credibly quote a higher new money rate to win distribution. That inflow funds more origination. The flywheel doesn't spin because someone twists knobs recklessly. It spins because every local decision, optimize spread, meet guidelines, place product, adds torque. Liquidity is the counterweight the model can underweight. Funding ladders, FHLB advances, repo, committed bank lines, are baked into the plan so insurers don't have to sell bespoke loans in a storm. But reliance has a way of creeping. When origination scales and mandates absorb more private assets, the share of the book that needs those ladders rises. If warehouse takeouts slow, the insurer becomes the safety valve, committing balance sheet to clear pipelines that would otherwise back up. It works until several valves open at once. Defenders of the machine say it solves a real problem. Banks won't hold many of these assets anymore, and insurers are natural long-term owners. They'll point to infrastructure loans with contracted revenues, senior secured corporate paper with tight covenants, and ABS with hard collateral and over-collateralization. They'll argue that matching annuity cash flows to these instruments is exactly what prudence looks like in a world of scarce public yield. And when cycles bite, they'll say, hands-on workout teams protect value better than a trading screen ever could. Critics ask a simpler question: who sets the terms when the house buys from the house? They worry about slow-moving marks, optimistic loss assumptions, and the temptation to prioritize warehouse relief over policyholder prudence. They point to correlated exposures, consumer receivables here, offices there, sponsor-concentrated private placements everywhere, sitting on multiple insurers tied to the same managers. When a refi wall looms, does the machine price risk to clear, or smooth it to wait? The truth lives in the choices people make when the model pushes and reality resists. In calm markets, originate to insure feels like elegant plumbing. Cheap capital meeting real economy borrowers through balance sheets built for time. In stress, it tests whether governance can overrule momentum. Pass on the deal that fits the box but stretches liquidity. Mark the loan that wobbles before the model admits it. Use sponsor cash to support the insurer rather than the other way around. For families and retirees, the machine is invisible. They see a rate and a promise. The machine sees a spread target and a pipeline. If those two stay aligned, checks clear and confidence compounds. If they diverge, you find out which promise the system was built to keep. So what actually stands between a family and a broken promise? Start with the safety net closest to the ground: state guarantee associations. Every state maintains one, funded after failures by assessments on surviving insurers. If a carrier goes down, the association steps in to keep payments flowing, up to a cap that varies by state and product. For many annuities, coverage lands around a few $100,000 per owner per company. Helpful, but not infinite. And there's a catch. These protections aren't pre-funded like deposit insurance. They activate after the fact, which means delays. Solution: keep emergency cash, diversify issuers, and choose simpler contracts so you never have to test this net in a storm. Coverage also depends on where you live when a company fails, not where you bought the policy. Move across state lines in retirement, and your protection can change. Some states exclude certain riders or limit how market value adjustments are handled in a failure. None of this is front-page language on a brochure. It lives in quiet FAQs on Guarantee Association websites and in statutes you only Google after a scare. Now zoom out to resolution mechanics. When a life insurer tips into trouble, state regulators don't do bank-style weekend seizures. They appoint a receiver, triage liabilities, and look for a buyer. Policies can be transferred to a solvent carrier, sometimes with terms adjusted under court oversight. If no buyer appears, a runoff begins, with guarantee associations stepping in to fund covered claims and assess peers to backfill the pool. Those assessments ripple through pricing later. In a single failure, the system works, if a bit creaky. In a cluster, it strains. The priority stack matters too. Policyholders usually sit ahead of general creditors, but complex capital stacks, surplus notes, affiliate claims, can complicate recoveries. And remember the offshore loop. If liabilities were ceded to a Bermuda affiliate, the U.S. entity's recovery depends on intercompany treaties and the affiliate's solvency. Regulators can push to upstream assets. Cross-border lawyering decides how fast and how much. Many people lean on ratings as a proxy for all this. AM Best, S&P, Moody's, and Fitch analyze capital, asset quality, liquidity, and parental support. Their outlooks move markets and distribution lists. But private assets create blind spots. When much of the book is marked to model, rating agencies have to trust governance, valuation committees, and stress scenarios provided by the companies. They push, they probe, they haircut, but they don't run the portfolio. A clean rating isn't a promise, it's a judgment under uncertainty. Sponsor support is the ghost in the room. Analysts often assume that a powerful parent, Apollo, Blackstone, KKR, will step in if a linked insurer wobbles. Sometimes they do. They'll inject capital by paper, backstop a facility, or slow fee extraction. Sometimes they won't or can't because shareholders have other priorities or markets are closed. Strategic importance in a report is comfort food, not a contract. So, what can a consumer actually do? Look for red flags you can see. Reinsurance. Scan the statutory statement for reinsurance ceded to unauthorized affiliates. Large percentages to offshore entities, especially Bermuda, signal the loop. Not bad per se, worth noting. Affiliated investments. In Schedule D, check how much is managed by or bought from related parties. Rising shares without clear governance disclosures mean more house-to-house flow. Liquidity reliance. Footnotes on Federal Home Loan Bank advances and other funding lines matter. Occasional use is normal. Heavy or rising reliance is a yellow light. Asset mix. Ask for a plain English breakdown. Public bonds versus private placements, ABS/CLO exposure, commercial real estate credit, and mortgage servicing rights. You won't get CUSIPs. You should get categories and percentages. Ratings trend. A stable A that keeps mentioning ALM and liquidity stress is different from one that talks mostly about surplus. Read the rationale, not just the letter. Product terms, longer surrender periods, firm market value adjustments, teaser rates that drop fast. These protect the balance sheet. Decide if they fit your life. Advisors have a duty to translate this into choices. A good one will push carriers for look-through, ask about Bermuda sessions and affiliated allocations, and weigh the trade-off between headline rate and simplicity. They'll compare a PE-linked platform's product to a mutual insurer's. Maybe a slightly lower rate, paired with fewer offshore ties and a plainer asset mix. They'll ladder maturities so you're not forced to exit during a rough week. And they'll disclose their incentive, how they're paid to sell what they're recommending. There's also a civic layer. Consumers can nudge transparency by calling state departments of insurance, commenting on NAIC proposals, and supporting moves that tighten capital treatment on opaque tranches. Better yet, demand standardized look-through, a simple, public template of asset categories, offshore sessions, affiliated percentages, and liquidity facilities. Complexity loves shadows. Templates turn on lights. None of this erases the core advantage insurers bring: the ability to hold long assets against long promises. In calm markets, private loans and structured credit can match liabilities well. In stress, the same features require patience and funding. Safety nets help, but they're not instant or unlimited. Fault lines run through liquidity, correlated exposures, and governance when the house sells to itself. Back at the kitchen table, the rule is boring and strong. Keep emergency cash so you don't have to test the plumbing in a storm. Diversify issuers. Don't chase one extra quarter point if it ties you to a complex loop you don't understand. Favor shorter surrender periods and clearer contracts over shiny riders. And write down 3 questions before you sign. Who manages the assets? How much is reinsured offshore? And what's your plan if surrenders spike? If the answers are crisp, you're closer to safety. If they sound like marketing, you've found a fault line. Action steps to protect yourself. Start with a simple checklist. Pull your insurer's AM Best or S&P report and read the rationale, not just the letter. Note RBC ratio trends and any shift toward ALM and liquidity language. In statutory filings, scan Schedule S for reinsurance ceded to unauthorized affiliates, and Schedule D for affiliated investments as a percent of assets. Ask for a plain English asset mix. Public bonds, private placements, ABS/CLOs, CRE credit, MSRs. Request current FHLB usage and committed liquidity lines. If answers stall, slow down. Choose simpler products. Shorter surrender periods, modest base guarantees, fewer riders. Ladder across 2 or 3 issuers. Favor mutuals or carriers with limited offshore sessions and clear ALM. For pensions that were transferred, learn your state guarantee cap and keep the transfer letter with your policy number. Keep 6 to 12 months of cash so you're never forced to surrender in stress. Calendar surrender windows. For advisors, insist on compensation disclosure and best execution attestations on affiliated deals. Call your state DOI and support NAIC look-through templates. Why the grab continues. Back to the big question. If the model has stress points everyone can see, why does the grab not just continue, but accelerate? Start with the simplest force in finance, demand. 10,000 baby boomers hit retirement age every day. They want certainty. Annuities promise it in a world where markets whipsaw and headlines shout. Banks are happy to sell CDs at 5% today, but they don't lock in decades. Insurers can. That means stable, growing premium inflows, fresh oxygen for any balance sheet tuned to turn dollars into long cash flows. The pipeline is secular, not cyclical. Promise, as long as inflows stay strong and capital keeps up, the model can fund real economy credit without scaring households if governance leads. Meanwhile, corporations with old defined benefit plans are still tired of pension volatility. They're not in the retirement business. They want it off their books. Pension risk transfers keep coming, some enormous, all complex, and the bidders who can price tightly, scale quickly, and tell a coherent investment story keep winning. PE-linked platforms, with origination engines, captive mandates, and the Bermuda Loop, show up with sharpened pencils. The queue forms because CFOs see certainty where markets offer noise. Now fold in the bank's retreat. Post-crisis rules made holding certain kinds of long-dated, illiquid credit harder for banks. As rates rose, deposits got flighty, and some banks pulled back even more. Private credit filled the gap. Direct loans to companies, infrastructure projects, real assets, securitizations of consumer cash flows. But private credit needs buyers who can hold to maturity and live with fewer marks. That's insurers. When sponsors also control insurers, the wheel turns smoother. Less time begging markets to clear deals, more time designing them to fit. On the sponsor side, incentives are baked in. Permanent capital transformed business models. Instead of raising a fund every few years and praying for exits, managers with insurance affiliates sit atop streams of premiums that don't need to be repaid on a timetable. That stability allows bolder origination, richer product stacks, and valuations investors reward. Fee flywheel spin. Distribution teams sell the next annuity at a slightly higher rate because the engine's already humming. Walking away from that is like walking away from electricity in a factory town. There's also an arms race dynamic. Once Apollo made Athene central, others followed. Blackstone built its own insurance pipeline. KKR, Carlyle, Ares, Brookfield, variations on the theme. If your rival can offer corporates tighter pension transfer pricing because they control both asset manufacturing and the liability vehicle, you either build a similar lane or lose share. When market share is the scoreboard and public markets reward AUM growth, the rational choice is to lean in. Complexity becomes a competitive advantage, not a hurdle. Politics gives cover. Framed correctly, This is long-term capital funding real economy projects, roads, data centers, energy transition infrastructure, affordable housing. Those are good stories in any district. Jobs in origination, servicing, and call centers show up in local headlines. The Bermuda conversation stays technical. Solvency equivalence, internal models, supervisory cooperation, not the stuff of nightly news. That reduces urgency. Regulators adjust around the edges. No one flips a switch. Demographics, banks pulling back, incentive flywheels, political narrative, those are the push factors. The pull factor is math. Public markets rarely offer enough spread, net of capital and hedging, to hit annuity pricing targets consistently. Private markets do. If you design assets with the end buyer in mind, and you're allowed to count them as investment grade, under a regime that respects internal models and diversification. Bermuda's regime, continuously refined, provides that treatment. US RBC, tightening but still accommodative in places, doesn't shut the door. When the math clears in both places, boards approve more of it. So what might slow it? The obvious trigger is a credit cycle that lands hard in the exact pockets this model favors. Senior private loans to sectors with weak refinancing capacity, commercial real estate exposures that need equity write-ins at scale, consumer ABS vintages that underperform together. If marks and cash flows disappoint across multiple sponsors at once, insurers could absorb pain, but at the cost of new business pricing power, ratings headroom, and political patience. A headline failure, especially if it touches a pension transfer population, would concentrate minds fast. A regulatory pivot could also bite. The NAIC is inching capital factors higher on structured assets. If those steps compound, CLO tranches treated more like their real risk, private placement factors reflecting historical loss in downturns, affiliated exposure limits that actually bind, the spread math tightens. If state commissioners push for standardized look-through and public audit trails on offshore sessions, the opacity advantage narrows. Bermuda is already proposing enhancements. If cross-border standards converge in a way that reduces capital arbitrage, the loop slows. There's a quieter breaker, funding backstops with limits. If federal home loan bank capacity gets rationed in a stress window, or if repo haircuts widen on the collateral insurers prefer, the model's reliance on always-on liquidity lines gets tested. That's not doom, it's drag. Drag changes pricing. Pricing changes flows. Flows change narratives. Yet even with those potential breaks, the baseline still points forward. Retirees need income. Corporates need certainty. Banks won't warehouse this risk. Insurers can. Sponsors have built the pipes and own the tanks. The machine is already in motion, self-reinforcing through fee economics, distribution momentum, and a regulatory perimeter that evolves slowly. The people closest to the gears believe they can manage the cycle with workouts, patience, and funding. They might be right most years. Which brings us back to households. The grab continues because it solves problems others stepped away from, and because it pays the people who solve them. That's not villainy. It's design. It works best when the risks are named and the cushions are thick. It fails when speed outruns governance. If you can't change that machine from your kitchen table, you can at least map where your savings sit inside it, and decide whether a slightly lower rate is a fair price for fewer moving parts. Back to where we started, the promise you bought and the bet behind it. The bet isn't that markets never wobble. It's that the people steering this new engine will slow down when the road ices. History says they sometimes do, and sometimes don't. Your plan should assume both. Problem: your promise is now tied to a complex engine you can't see. Urgency: delays and dense footnotes are tells that liquidity and governance matter today. Promise: you can still get the check consistently if you choose simpler products, diversify issuers, and keep cash for rough weeks. Solution: pull your carrier's filings, ask about offshore sessions, affiliated assets, and liquidity lines, and share this with someone holding an annuity or a pension transfer. Next, how shadow banking hides in your monthly bill.